We're living, as I said, that today we'll be looking at the market structure, and this is in continuation with what we have been uh, looking at in previous uh, days, still progressing or advancing on how a trade is created. And today we are going to look at the market structure based or basing our argument on what Elliot believed, because in Elliot theory, which is a form of technical analysis that looks for recent long price patterns that are related to persistent changes in the investor sentiment and psychology, in which he based or believed that every creation or every action in the market structure exhibit a reaction or a corrective movement. Thus, for every impulsive move, there will be a corrective one. For instance, as we looked at the swing high and the swing low, uh, we're going to see light straight away. We pick our path and we begin drawing from our most recent low, because in uptrade the most recent structure must be one where price creates a high that move past the previous high. As you look here, uh, this this zone here was the previous high, but now has been broken by this zone here. So this become our lowest point, the swing low, the swing high, and we are going to begin drawing our pattern right here. So we create the first impulsive move, then a zone of correction. Remember, we are basing our argument on Elliott theory. Then we have the third impulsive move, a point of correction. Then finally we enter into the fifth wave, which in Elliott theory, this becomes the final wave. So the first five waves in the chart form the impulsive move, moving in the direction of the main trade. And as you can see here, we are on the up trade. And then the subsequent three waves provide the corrective waves. Uh, Let us do some labeling here. We will label all these waves so that you can get this one here. Will wave one, just light one, okay. Wait just a minute. leave this alone. Okay, for now we will not label, but the first, the first. Okay, let me just identify this zone. Just a minute. Uh, the first five waves in the chart form the impulsive move, moving in the direction of the main trade, and the three subsequent waves provide the correction wave. So 1, 2, 3, they are the progressive wave in the direction of the pattern, and this becomes the correction waves. This one here, and this one is the point of correction. So this theory form uh, from the fifth wave here, you see the momentum changes from this point here, then the momentum changes where the market now is. So after the fifth wave is created, the market now changes momentum downward, and we reach a point where market now begin to consolidate. And after the consolidation, you can see the market did move all the way down, all the way down. Let's define the correction yield zone. This At this area, the market was at a consolidation, and after the correction, the market moved down and continues downward. So in the five waves, what defines who are in control is the velocity and the momentum of each impulsive move. In bear market, price is making lower lows and lower highs. Trade will continue until a lower high is created. The trade begins to show signs of weakness when lower low fails to create a lower low, and instead a lower high that is above the previous high is now established. In the same way, in the bull market, the price will continue making higher highs and higher lows until finally a higher high fails to create, and instead a lower zone is created. As you can see from our zone here, up here, the wave failed to create another lower high, and instead a lower yes please.